Hello and welcome back, everyone. Thank you for joining me, and a special thank you to every single one of you who has become a subscriber on Substack, Patreon, here on YouTube, or who has otherwise supported my work. I appreciate every single one of you. The US dollar has taken a sharp turn in recent weeks, and markets are starting to take notice. After years of relative stability, the US dollar is now down over 11% this year alone, and that might not sound like much in the world of currencies, but in macroeconomic terms, it is seismic. What's even more concerning is how this drop is happening, and the fact that at its very core lies the global loss of confidence in Washington. For years, the US has run extremely loose fiscal policy, trillions in deficit spending, massive debt accumulations, and very little political appetite, if any at all, to be frank, for serious fiscal reforms. At the same time, trade tensions and tariff uncertainty, particularly under the Trump administration, have added investor unease. While many brushed off concerns about the dollar's reserve currency status in the past, the recent developments are causing even the optimists to take a step back. It is not that the dollar is about to lose its dominance overnight. It's not going to happen overnight. Becoming the world's reserve currency took decades, and this is something that I will cover in greater detail in one of my upcoming videos here on my channel. But it is not something that will unravel in the matter of months, in the matter of weeks, but there are growing signs that a risk premium is now being built into the dollar. In simple terms, it means that investors are beginning to demand more and more compensation for holding US assets, and that shift in sentiment can snowball very, very quickly. Let's take a closer look at what's driving this change. Earlier in the year, some of the dollar's weakness was attributed to external factors. For example, in March, Germany surprised markets with a large fiscal stimulus package. That news alone caused the dollar to drop 4% on a trade-weighted basis, and when you factor that in, the dollar's performance since the US election didn't really look too bad, basically flat. But something has shifted. In recent months, the dollar has fallen sharply against the G10 peers, even as US rate differentials have widened. In plain language, the gap between US and foreign interest rates has grown, which is normally a reason to buy the dollar, not sell it. The fact that the dollar is still falling suggests something is fundamentally broken in the usual relationship between rates and currency strength. This is not just market noise. It is reminiscent of the 2022 UK scenario, where investor confidence cracked in the face of unchecked government spending. The same kind of fears now seem to be bubbling in the United States. And Wall Street is taking notice. Morgan Stanley, one of the most prominent investment banks in the world, now predicts that the US dollar index will fall another 9% by the middle of next year, dropping to levels last seen during the depth of the pandemic. The bank's strategists believe that we've entered a new phase, one where long-term trends are pointing toward a much weaker dollar and much steeper yield curves. Other major banks are echoing these warnings too. JPMorgan has turned bearish on the dollar as well. Their recommendation is to avoid US assets and to look to the yen, the euro, and Australian dollar instead. These currencies are now seen as safer bets, and in some cases, they offer better returns. So let's put this in perspective. Since peaking in February, the US dollar index has dropped nearly 10%. Much of that is being blamed on trade uncertainty, the Federal Reserve changing stance, and increasing doubts whether US policymakers can or will get deficits under control. The biggest winners from the dollar weakness are likely to be America's major currency rivals. According to Morgan Stanley, the euro is expected to rise to around $1.25 next year. The British pound could jump to $1.45 next year, supported by relatively low trade tensions between the UK and the US and strong investor returns. The yen could strengthen dramatically to 130 per dollar. It is not just currencies moving either. Morgan Stanley also expects 10-year US Treasury yields to hit 4% by the end of this year before falling again next year as the Fed delivers as much as 175 basis points in rate cuts to cushion a slowing economy. That is a massive shift in monetary policy, and it is coming at a time when confidence in the United States fiscal outlook is already deteriorating and deteriorating quickly. So what does all of this mean? If the dollar continues to weaken, it sends a very powerful signal to global investors. It suggests that the world's largest economy is no longer immune to the consequences of fiscal mismanagement, and that the US dollar, which is long seen as the ultimate safe haven, might no longer be the sure bet that it once was. Of course, we're not witnessing the collapse of the dollar, not yet. The US still enjoys enormous structural advantages such as deep capital markets, economic scale, and geopolitical clout, but the cracks are starting to show and they're widening. They're impossible to ignore. And once confidence begins to slip, it can be very, very difficult to regain it, or virtually impossible to regain it. The fall of the dollar isn't just about currency charts or bond yields. It is a reflection of deeper anxieties about the future of the American economic model, about trade wars and mounting debt, about a government that may have overplayed its hand, and a market that is finally starting to push back. For decades, the dollar's dominance was a given. Now that certainty is beginning to fade, and fade fast. And if history teaches us anything at all, it is that financial empires don't collapse all at once. They erode slowly, then suddenly, all at once. We may not be there yet, but the warning signs are flashing, and the world is watching. What are you doing to protect yourself during these uncertain times? Let us know in the comments. I would love to hear from you. Give this video a thumbs up, consider sharing it, and subscribe here on YouTube. I would love to have you back for my next one. And if you enjoy reading and for more content, find me on Substack and Patreon. I would love for you to subscribe to my alternative social media channels as well. I will see you back here tomorrow. Take care.